Hello, this is Carlos Bennett again, CEO of Usurance Financial, and today I'm going to show you how to properly structure an IUL so it'll maximize your income in retirement. So most people think life insurance is just something that pays you out when you die, right? But certain policies, like a properly structured IUL, can actually build cash value that you can increase and use while you're still alive. The idea is simple. Part of your payment goes towards the protection of your family, the death benefit, and a majority of your premium goes towards the tax advantage account that grows based on a market index like the S&P 500. And it does this without being directly invested in the market. And that's how, when the market does go down and you experience any losses, you will not have any decrease in your cash value account whatsoever. So let me show you a quick video that really breaks down a real life situation on how cash value can work for you while you're still alive. And this is why a lot of families and business owners are using this strategy as well. So that being said, as you can see, my client here, Jane, she's funding her policy with approximately $1,000 per month or $12,000 on an annual basis per year. So in this section here, you can see the annual premium, which is $12,000 a year. And her starting death benefit here would be about $426,000 in legacy benefit for her family if something happens early, right? But the whole reason we're here today is to look at the cash value growth. So as you can see here, the account value is how much cash value she has available to her. And the surrender value is the amount that if she decided to let go of her policy and surrender it to the insurance company, they would write her a check for this full amount. So we'll scroll through Jane's life, and she's starting this policy at the age of 25. So we'll go all the way up to retirement age, 65. So at this point, the policy has been active for 40 years. As you can see, as soon as she hits 65, the premium payments will cease to exist, meaning she does not put another penny into her policy. Because when you retire, the whole point is downsizing your expenses, not keeping them the same or, God forbid, increasing them, right? So, age 65, Jane is finished paying into her policy. Now, at this point in time, she would have accumulated a little bit over $2.3 million in cash value for the policy, and her death benefit would now be sitting at a little bit north of $2.8 million. So once Jane retires at 65, she'll start taking, in this example, a distribution, so an annual income of $220,000 per year coming directly from her cash value account. Now, over time, she will receive this $220,000 income payment all the way up until age 90. So if you do a little math, she has received over $5.5 million in cash value payments from her policy, although she only funded it with an accumulated $480,000 over the course of 40 years. So Jane was able to receive a $220,000 annual income just from her cash value within her policy. Now, at this point, let's say something happened at age 90, she would still, even after pulling out $5.5 million from the policy, she would still have a death benefit of $621,000 to pass on to her family. Now, hopefully, Jane lives a very, very long and fruitful life, right? So let's say she lives past the age 90. The policy, even though she would not have paid in it since the age 65, would just continue to grow and accumulate. So we'll go to the nice ripe age of 100. At that point, even if Jane had liquidated a majority of her policy, it would have then grown to another $1.3 million in cash value she can either use, or she would have accumulated another $1.3 million that she could decide to pass on to her family if she wants to just let the money sit there. So through this example, you can see that a life insurance policy like an IUL, when structured properly, is not just a death policy, it's actually a long-term accumulation vehicle you can use to fund your retirement, fund a business, purchase real estate, and overall just enhance the quality of your financial strategy in addition your retirement. If you found this information helpful or you have any questions on how this works, click below to see how you could build your own tax advantage income strategy today.